So today, folks, it is February the 2nd, 2023. This is the first Debt Free Life presentation of February. I think we did one last month as well. And what we're doing today is we've got a special guest with us today, whose name happens to be Betsy Barr. Or you may call her Queen B. I like to call her B squared, or just the Bar. The high bar, right? So you got a lot of names you can call her, but she's phenomenal with the Debt Free Life program. She's taken it from a different angle, which means her presentation is different. And we know that different people's presentations are going to resonate with different people. So today, what we're going to see is we're going to see Betsy's version of a presentation. So Betsy, I think you started about 2 years ago. You're on your way to agency owner here at Symmetry Financial Group, if you're not already there. And you have a phenomenal mechanism and system that you've built out to generate, leads and all that kind of stuff. And I know the Cook agency is using it, and they've had phenomenal success. So congratulations on that. But besides that, I don't know your production. I just know it's high because I see your name on the leaderboards all the time, which means you have to have high production. And I'm very pleased and I'm thankful and grateful that you've taken time out of your day to come present with us. And then after this, be preparing your questions because we're gonna play Stump Betsy is the name of the game after her presentation. It's gonna be a good time. So without further ado, ladies and gentlemen, the Betsy Barr.
Well, my goodness, thank you very much, Scott. It is definitely an honor to be here with you guys. So Betsy Barr, I'm a key leader on my way to AO. And I'm direct to Mark Neubauer in the Chris Cook organization. Love DFL. I started with it in fall 2019 and have just fallen more and more in love with it every day, and just so many opportunities and ways that it can help families and open doors to just get into some even bigger ways to address every single member of the family. So like I said earlier, this is what I created after a lot of questions, a lot of helping explain difficult things. And so anyways, I hope that it is a benefit to you. So debt-free life, what are we working towards? We are working towards helping families, who don't want to have a mortgage payment during their retirement years. They want to become their own bank, and they want to pay off that mortgage without refinancing or without having to increase their monthly payment. And so, of course, we always ask that really important question. If your mortgage and your debts were paid off, would your retirement be more comfortable? I have yet to meet someone that has said no to this question. All right, so we go over a few things that, of course, the debt-free life plan is not. So we are not a debt consolidation. We don't assume your debts. We don't tank your credit score with this. You keep paying your debts. No one's going to pay your bills for you. We are not debt consolidation. We're not refinancing. I'm not a mortgage officer. This is not a get rich quick scheme. Okay, guys. We do help families pay off their mortgage, usually in 7 to 9 years, which is so much faster as compared to 30 years, but like you're not going to have everything done, next week. That would be sketchy, and we don't play that game. We're not an MLM. You don't have to, find 5 friends and sign them up in order to take advantage of debt-free life. We're just here to help one family at a time. And this is not a HELOC. You don't have to assume more debt in order to pay off additional debt. All right, so let's talk about where American families are. All right, so the whole idea of debt-free life was to meet families where they are. So we need to figure out, where are they? Most of them are just trying to pay off. They're just trying to survive. All right, they're just trying to get their bills paid, hopefully have a little bit left over at the end of the month, and get out from under that weight of debt. That's the reality that most people are struggling with, especially now with inflation and all that's going on. And so we need to understand that that's where people are. And I always share that, when I started Debt-Free Life, my family was not in a great financial position. We had just moved back to America from overseas. My husband's health was in dire straits. We didn't know what was going to happen with him. We had medical debt. We weren't planning for this move, so it messed up all of our jobs. And so we had some credit card debt. We were trying to get established again in America with a home. Could we even get a home? Where would we find a car? it was not a great place for our family. And so when we found Debt Free Life, after, you know, I was at Symmetry and found Debt Free Life, it was really a turning point for us. It turned things around. It helped our family kind of get out of the financial difficulties that we were in. And so it made such a difference. And this is one of the reasons that I'm so passionate about it, is because of what it's done for my family. And so just understanding kind of who we want to help. We want to help people that otherwise would not have known about this. And so this is, and one thing I always tell people, this is a no judgment zone as we talk about Debt Free Life, because again, the reason I'm so passionate about it is because I know I just know what it did for my family. So what we're doing is we're looking at what is the reality for the wealthy. Okay, so we see what most people's reality are, but what's the reality for the wealthy? The reality for the wealthy in our society is that they figured out a way to leverage their money, all right, and make their money work for them, and not just for them, but for generations of their families. So for their children, for their grandchildren, for their grandchildren's grandchildren. And so what are some strategies that they're using? How can we use those same strategies? Maybe I don't have $500,000 a month, but what if I've got $200 a month, $500, $700 a month? How can I leverage that in the same way that Walt Disney, Warren Buffett, the Rockefellers, Ray Kroc with McDonald's, how can I leverage it to create that kind of wealth for my family? So we're going to go into a little education piece. Like I told you, I used to be a teacher. All right, so we're gonna do some education moment here, okay? And just a heads up, there may or may not be a quiz coming up, so just be aware, okay? So how do the banks make money? So let's see, who can I see here on my screen? So let's say, Aubrey, you've got $1,000 and you're like, I am going to go put that in a savings account at my bank. So you go, you put it in, and they're like, wow, you are such an amazing customer at our bank. We're going to let you earn 1% interest on your money. Congratulations. Here is $10 for you. Okay. So you're like, most people tell me, I don't earn 1% interest on my savings account. I mean, most banks don't offer that. But then what are they going to do with that $1,000? They're going to take that and they're going to loan that out 7 different times. That's what they're allowed to do. And they're going to earn interest every single time they loan out that money. So what's happening here now is that the bank has brought in about $700, just over $700 in interest on your $1,000. And how much have they given you? Somebody, how much do you get? Does that increase for you? You get $10, okay? And they make it sound like that's just really amazing for you. So what
we're going to Shoney's.
We're going to Shoney's. I don't even think I can take my kids to McDonald's on it. So what the wealthy said was like, hey, the banks are making all this money. I mean, how can, instead of the banks making money on my money, how can I make money on my money? That's what we want to see, is how can, instead of the banks taking all that interest, well, we need to turn that around somehow. All right, so another little education piece. How do insurance companies make money? So most people are getting term policies, right? We're all, especially if you're an insurance agent, term is cheaper. All right, it's less expensive, and hopefully at the end of that term, the family is still alive. We're not selling these policies hoping that families are going to pass away, right? We want the family, we want the person to still be alive after the end of that term. So what's happening is that insurance premiums are put into a policy. The carrier and the client, they have a contract. And so the insurance companies, they receive the premiums, they keep that in a general fund to invest it. And then they've got now all this money sitting. So, they're smart business people. They're like, hey, how can we, generate some additional income? So what they do is they say, hey, there's some people in the economy that need some money. So they actually loan out money to third-party lenders like credit card companies, banks, auto, mortgage companies, and who then mark it up and offer it to us as the public. So that's one of the ways that money is circulating in society. So what happens here with the insurance company is if you are a participating contract holder, which means you're participating in the profits of the insurance company, then you are given an opportunity to borrow from the insurance company at a lower fixed rate. Okay, so this is kind of just one of the ways that insurance companies are making money. And so let's talk about this participating whole life policy. So this is not your grandmama's whole life policy. Okay, this is not, okay, we're going to have, $12,000 and be able to bury, my family can bury me. This is a different type of policy. So a lot of times what I see when I'm creating these policies is that the amount that my clients need to put in actually goes down over time. Okay, so the amount for them is decreasing, which can be helpful, for families, if I'm helping a, couple in their 20s, 30s, 40s, and when they hit retirement, they don't want to have to put additional money into a life insurance policy. So we can just create it to where what they contribute decreases over time. There's a lot of flexibility with these policies. And then over here, this is where my math nerdiness comes in. You'll notice that can be a decrease. It's decreasing, but whoa, what's happening over here is we are increasing, not just increasing in a linear fashion, we're increasing exponentially. That means we're growing, and there's growth upon growth upon growth. And so a death benefit is what all life insurance policies have. If I have a life insurance policy and I pass away, then my husband would get the death benefit. But what the cash value is, let's talk about that terminology for just a moment. The cash value is what I, as the insured, actually have access to while I'm still alive. All right, so it's something that I can use for my family while I'm still living. And what's awesome about the cash value, all right, it's cash. It's just like liquid cash asset that I have access to, okay? All right, I told you there was a quiz. What do you think all of these banks have in common? So either type it in the chat or answer. What do you think that all of these banks have in common? All right, do we see anything? Anybody want to take a guess? All right, they offer checking accounts. Yes. All right, Scott, you know the answer. All right, yes, all of these banks right here, oh, there's two Scott Simkin. Yes, you're correct. All of these banks own life insurance as an asset. All right, and so what that means for these banks is this is actually called something called BOLI, bank-owned life insurance. And so this is from March of 2022. So I don't know if you can read down here and find your bank. Our family banks with Regions. Regions has $3 billion of assets inside of life insurance policies. So our money is in Regions. They're earning interest on our money, and then they're also earning additional money on our money because it's inside of a life insurance policy. All right. So we show this here so that, you can understand this is not something where, hey, we're taking the spaghetti throwing it against the wall and hoping that it sticks. All right. This is something that's been around for a while. And kind of going back to what I said at the beginning, we're looking for strategies. What are the wealthy in our society doing? What are the people that understand money, that know money? What strategies are they doing that we can then share with your average American family? All right. How can we help just your regular American change their financial future in some way? All right. So now, second quiz question. What do all these companies have in common? Hopefully a little bit easier to answer this time. Same type of thing. All of these companies also own life insurance as an asset. And so why is it exactly that they do life insurance as an asset? Is because life insurance is the only financial vehicle where you can do two things at one time. Okay, so instead of just using your money in one way, you're able to leverage it in two ways. So you can earn interest on your money and borrow against it at the same time. All right, that is the power of life insurance. So what are we using for this? We're using the tax code section 227702. So what this allows us to do is we can put money into a life insurance policy and pull that out tax-free. Okay, and so we put in money into a premium, put the premium into the policy, And then we have access to the death benefit. That's all tax-free. And we have access to the money inside the account that's growing, also tax-free. All right. So this is how we're allowed to do it. It's all legal. All right. These banks are doing it. The companies are doing it. And now you can do it as well. So let's talk practically, like, what does this look like? So the reason we do this, again, we talked about how banks make money, how insurance companies make money, and now we're going to talk about how you can make money on your money. So let's say that you have $20,000 of cash value in this participating policy. Okay, now you can put that $20,000 in as a lump sum. You can put it in as like monthly payments that build up over time. Lots of different ways that can get to $20,000. But for the sake of argument, we're going to say it's $20,000. Okay. All right, then let's say that I have got a credit card. Okay, you know, Christmas was last month and now I'm getting all my credit card bills. Oh no, here's my Christmas bill for $6,000. Uh-oh. So what I'm going to do now is say, hey, I want to borrow $6,000. I want to use $6,000 from my policy to pay off my credit card. So what's actually happening is that money is coming from the insurance company. So remember how we talked earlier about how insurance companies make money? So I'm actually borrowing $6,000 from the insurance company. All right. It's at a fixed simple interest, 3.85%. So that means I'm going to owe them $231. All right. So here you might be thinking, all right, Betsy, but why would they loan you money? Like, why would the insurance company decide, okay, you, Betsy Barr, get to borrow money? Or why would they let me borrow money from them? Like, what's the catch? What's in it for them? So you got to remember something. If I'm taking this from my life insurance policy, who holds my death benefit? Who's in charge of that? Who writes the check for the death benefit on my life? This insurance company does. So if I borrow $6,000 from them, and, you know, I've got the best of intentions, I want to pay them back, but then next week, you know, I'm down here in Hawaii, I go swimming in the ocean and I get killed by a shark attack. All right. Then what's going to happen? Instead of giving my husband the full death benefit, let's say $500,000, they would give my husband $494,000. So the insurance company doesn't mind letting me borrow $6,000 because they're the one in control of my death benefit. Now, it's kind of morbid, but they know that I'm good for the money. I'm either going to pay them back when I'm still alive, or they're just going to keep it from the death benefit when I pass away. All right. So that's one of the reasons. That's kind of why this actually works. Okay. Now, the cash value, think about it as your credit limit. Okay. So if you've got a credit card, all right, and it has a $20,000 limit on it, and you swipe it and you put $6,000 on it, you've got $14,000 left. Okay, so that's kind of how the cash value works. If I borrow $6,000 today, well, tomorrow I've still got $14,000 that I can pull out and go on a joyride if I want to. All right, now here comes the really fun part. This is the exciting part. This is where the beauty of debt-free life comes into play. So I'm going to keep earning a minimum of 3% compounded interest on all $20,000. So that means that I'm earning a minimum, because we're all basing it on the minimum growth here, of $600, even though I'm using this $6,000 over here that I've borrowed from the insurance company. And so this is why it's important to understand that when you take money from your policy, it's actually coming as a loan. You're borrowing it from the insurance company, because then inside your policy, it's like, oh, look, there's all $20,000. Let's keep earning interest on that. Okay. But then that $6,000 is coming from the insurance company. So here, even though I'm borrowing money and I owe them $231 in interest fees, the amount that I'm earning is outperforming that. So I'm now earning a profit of $369. Okay. So this is a great point to kind of just sit, take this in, make sure it all makes sense. We can go back and clarify anything on there if need be. So some different ways to think about it. You know, remember I talked about the two different ways. So we're taking that $6,000 and we're leveraging it twice. So in one way, we're using the money inside the policy. That $6,000, it's inside, it's earning interest, it's saving for the future. But then at the same time, it's outside of the policy. It's paying off my debt. I'm financing a future purchase with it. So I'm using my money in two ways. So how can we leverage this long term? So it's better than a loan because it's already your money. So if you're working with real estate investors who, are trying to like get a new home or, put a new down payment in, or a business owner that needs to get some new equipment, or maybe it's a family that, oh my goodness, my tires just blew out and I'm going to need to go and get a personal loan or put it on a credit card just to get new tires. Well, you can just pull it from this policy. All right. It's just as simple as a transfer from an account to an account. Give it, 2 to 4 business days to get there. But it's your money. You don't have to go fill out paperwork and get someone else to approve you to take out your money. Now, then this is the part that is for our family made the biggest difference. Okay. It's better than a savings account, y'all. This is like a savings account on steroids. All right. Because you're going to earn interest on the entire principal, even when you're using the money. So like for Christmas, all right, for my husband and I, Philip and I, we have a policy where we put stuff that we would in for savings, like, birthday money, Christmas money, vacation money, things that we pay on an annual basis, we put into our policy. So then when it comes time for Christmas, pull out the money from the policy. I go buy the Christmas presents. Christmas morning, I'm drinking my coffee, watching my kids all happy, and I'm super happy too, because the money that paid for those presents is still earning interest in my policy. That is a very Merry Christmas for mommy and daddy right there. All right. And so here I'm just leveraging my money in 2 ways. All right. So let's kind of, so that's kind of the nitty gritty of how it works. So let's give an example here. So let's say that you're going to buy a car. I'm going to show you 3 different ways that you could buy a car. So you could go the traditional way. You could buy it with a car loan. So you could say, all right, I'm going to get a $10,000 loan for a car from the bank. I think I'm going to have to increase that number because I don't know where you could get a car for $10,000. And you're going to pay interest though to the bank. So you're going to pay about $2,300 in interest. So now over time, what does this look like? Over time, you're not going to have access to that 10 grand anymore because you used it to buy the car. You're also going to have paid about $2,300 in interest, but you'll own the car. So we call this a lose-lose-win situation. All right. Now, have you ever heard cash is king though, Betsy? Cash is king. I do everything with cash. And that's amazing. You don't have any debt? That's phenomenal. Congratulations. I love that for you. Let me show you though what's happening when you buy things with cash. So you just pull it out of your account and boom, you pay it down. Awesome. So over time, well, you don't have access to the $10,000 anymore because you exchanged it for the car. You didn't pay any interest, but you didn't earn any interest either, right? So it's 0 interest paid, 0 interest earned, and then you own the car. So this is kind of like our lose, neutral, win situation. Let's see how we turn it into a win-win-win, shall we? Now here with our debt-free life policy, okay, I'm going to pull out $10,000 from the policy. I'm going to owe them about $1,263 in interest. However, I'm going to earn a minimum of about $1,900 in compounded growth. So that means that over time for me, I'm still going to have access to that 10 grand. I would have made a net profit of almost $650 in interest, and I'm still going to own the car. So now I've turned this into a win-win-win situation for me and my family. So this is what the power of debt-free life can do. And this whole process right here is something that we call infinite banking. So this is how we can bypass the banks, pay ourselves, and leverage our money in 2 different ways for ourselves. So debt-free life is actually 2 separate pillars. Okay, so we use infinite banking. So when I come across people that say, well, I actually don't have debt, or I don't even have a lot of debt. Oh, that's awesome. Then we don't have to use the second pillar. We just focus on infinite banking. All right, because that's a really powerful tool to leverage for your financial future. However, if you do have debt, then we pull in another idea called the debt snowball. And so with debt snowball, what we're saying is, let's say I've got this Chase credit card, all right, and I got to pay $256 off to pay that credit card off. So if I am paying about $25 a month, when I'm done paying off Chase credit card, I could take that $25 and go to Shoney's, right? Or I could take that $25 and I could put it towards paying off my Citibank credit card. So now I move it up. I start paying this one off. So I'm going to pay it off a little bit faster. And then let's say my Citibank credit card, the minimum payment was $75. So once I pay off Citibank credit card, well, now I've got an extra $100 in my budget. We could even go like, we could go to Texas Roadhouse or something every once in a while. All right. Instead of Shoney's, we're going up in the world. Or I could take that $100 and I could put that towards my Chase Freedom. And I could pay off my Chase Freedom faster. And then once I'm done with Chase Freedom, I put all those minimum payments towards my MasterCard. And then so I'm snowballing the payment. That's what the debt snowball is. I'm helping increase how quickly I can pay things off because I'm leveraging that money. Now, here's the thing, y'all. Numbers don't lie. That's why I love numbers, okay? This can work. If you focus on this and you leverage those funds, this is going to be a great way, to help pay off your debt. However, let's just be honest. Who has ever tried to set a budget and then Friday night comes around and you're like, this has been a hard week. We are just going to go through the McDonald's drive-thru. Anyone ever done that? Maybe not McDonald's, but maybe something. Life happens, okay? And so we understand that life happens. And when we're working with families, I see here that it looked like I raised my hand. So we understand that life happens with the families and the clients that we're working with. And we want to be sensitive to that fact. And we want to help them understand that, okay, we're not here to tell them, okay, you can only eat rice and beans. Okay, if you get off of this plan, you are a failure. Okay, like no one wants to hear that. Like life is already hard enough, right? And so what we try and do with this plan is say, hey, this is a great strategy. These numbers really work, but it's really easy to get off track. And we don't want you to feel like your whole life has to change if you go off track a little bit. So what we do with Debt Free Life is we take this great idea of debt snowball and the pros of that, and we take the positive part of infinite banking and we marry the two. All right. And the hard part about infinite banking is that it's just hard to implement. All right. It's just it's a complicated strategy, figuring it out, maintaining it for the long term. It just takes a lot of effort. All right. And a lot of people, they just don't have the time to do that because they're so busy, just living their life, paying their bills, getting their kids to all the activities and all that good stuff. So what we do with Debt Free Life is we say, hey, how can we put these two together? So here's an example. What does this look like practically? This is actually a teacher that I used to work with. I got to help her and her family. And anyway, so they had some debt. They had some consumer debt and they had a mortgage. They just refinanced. So it was going to be a lot more interest. So their real debt was about $376,000. Okay, now what we were able to do with Debt Free Life is instead of them waiting 30 years to get everything paid off, we actually were able to get it paid off. It's going to be paid off in 8 years and 3 months. Isn't that awesome? Man, this is the part where I get giddy when I see this. I get so excited. And so the awesome part too is that I was able to get them help without them spending any additional money per month. She's a teacher, he's a firefighter. They don't have, it's not like they've just got an extra, $1,500 sitting around every month. But they were already trying to get out of debt. They were already working towards how can we pay this off faster? They were putting a little bit extra towards the mortgage, putting a little bit extra towards the credit cards, putting some extra into savings so they could chunk down money. And so I said, well, hey, this is the comparison, okay? This is what you're doing right now, and this is how much you'll be able to how soon you'll be able to pay it off. And but if you take that same strategy that you're using right now and that same money and we put it in a debt-free life plan, this is what we can do for you. And they said, well, The debt-free life plan makes more sense for us. It's going to put us in a better financial position long-term. It's going to help us meet our goals of retiring early once we've hit our 30 years. And so they went with that. And so, of course, I was so excited for them, got to help them get that set up. Here was the plan that we set for them. They put in a lump sum to begin with. And so we were able to pay off those credit cards initially. The rest of their debts were a little bit larger. Okay. So like, 41, 22, 37,000. And so we had to wait a little bit longer to get those paid off, but that's okay. All right. Because it's still going to be paid off sooner than it was. And they know, hey, they've got a plan. All right. And if something comes up, like they had some stuff come up last year where, hey, they needed a little bit extra support to get through, this one or two situation, and they had access to those funds. And so they could just pull them out and be able to use that in a way that supported their family at that time. So this is the debt-free life plan that we share with families, and then we help kind of walk through. This is when we're going to pay off this debt. I'm going to help you figure out how to do all those steps, and our team is there to support the families in that. Then we look at, okay, they're saving about $54,000 in interest. Isn't that awesome? That's amazing. That's just money that they get to keep in their bank account. Isn't that great? Two people that are serving our community, and we get to help them. I mean, that's like more than their salaries. Okay. $3,100 a month, $3,119 a month. Now that gets to go towards their retirement. They're getting all the debt paid off. They'll have equity in their home. And so what this means for them is after 20 years, with the money that's building up in the policy, as well as the amount that they're saving each month once all the debt is paid off, after 20 years, they're going to have just over $540,000. And so as I was speaking with them, I was like, okay, what does that mean? Like that's a big number. What does that mean for you? All right. And so like I was saying, they're both like early 40s, late 30s, early 40s, and they would like to be able to retire early once they've hit the 30 years with the county. And but when they do that, there might be an income gap where they might have to pay a whole lot extra for health insurance before Medicare kicks in. And so just saying, hey, this is how much you'll have access to. Would this help you be able to retire early? Would this help you be able to send your kids to college? Can this help you make sure that you can pay for your kids' weddings, maybe help them with the down payment on a house? This could help them reach all of the goals that they told me about as we met together. All right. And that's the power of debt-free life. It's not just, okay, I'm going to get you out of debt in 8 years and 3 months, but also how's this going to change your financial future? And then of course, because it's a life insurance policy, when they do pass away, this is going to be a massive lump sum that is left to their children tax-free, that now we can just cycle that, and now their grandchildren will have access to funds, their great-grandchildren, their great-great-grandchildren. So now we've totally changed the financial future for this family, all because we said, hey, here's a comparison, which one fits your situation better. And so anyway, so that is Debt-Free Life. If you're interested in learning more, we'd love to chat some more. But that is the presentation that I give. So Scott, I will pass it over to you. I'm ready for the grilling.